Welcome to The Deep Dive, your essential briefing on what's truly driving the market.
We take you straight into the heart of earnings calls.
Exactly, extracting those critical insights you need to stay ahead.
Get you up to speed, fast.
Today, we're embarking on a deep dive into the fiscal 2026 first quarter earnings call for CSW Industrials. This is a company that just reported what management proudly called record results.
Right, but they're doing that while navigating a really complex and shifting economic landscape.
Yeah, it's quite the balancing act.
It's a truly fascinating situation, isn't it? We're looking at a company firmly committed to an acquisition-led growth strategy. That's a deliberate strategic pivot, and it's influencing pretty much everything they do.
But that strategy comes with trade-offs, right?
Absolutely. It means they're facing some very real short-term pressures on organic growth and, well, their profit margins. Our mission today is to unpack these strategic shifts, understand what they signal for CSW Industrials' long-term vision.
And for you, the listener, this is about getting a clear picture of a company intentionally reshaping itself. What are the moving parts?
Let's get into it.
All right, let's get right into the headline numbers from CSW Industrials Q1 for fiscal year 2026. So the company reported record revenue of $263.6 million.
Which sounds great. That's a robust 17% increase compared to the same period last year.
Yeah, and they also delivered a record adjusted earnings per share, or EPS, that's a key measure of profitability of $2.85.
And that actually sailed past what analysts were expecting, a solid beat there.
It was, and their EBITDA, earnings before interest, taxes, depreciation, and amortization.
Gives you that clearer picture of operational cash flow.
Right, that saw a healthy 5% growth, too, up to $68.7 million.
Yeah.
So on the surface, I mean, a lot of green.
And that's exactly where the nuance becomes crucial for you to understand. While those headline numbers certainly look strong, the full story is, well, a bit more complex.
Okay, how so?
What we saw was that the reported revenue actually missed consensus estimates. A slight miss, but still.
Huh.
And more significantly, when you strip out the acquisitions, organic revenue that's growth from their existing businesses saw a 2.8% decline year over year.
So the core business dipped slightly.
It did. And this quarter also saw their gross margin contract by 370 basis points, landing at 43.8%.
Wow, 370 basis points. That's nearly a 4% reduction in profit per sale before operating costs.
Exactly. And their EBITDA margin was also down by 280 basis points, reflecting that broader pressure on profitability.
What a mixed bag. It's interesting how the market initially reacted to that kind of report. Shares actually surged, approximately 13% pre-market on the strength of that EPS beat?
Yeah, the initial reaction was strong, but as the earnings call progressed and those nuanced details emerged, well, that initial enthusiasm definitely tempered.
Right. We saw shares drift lower throughout the call,
Yeah.
ultimately closing down 3.5% on the day.
Mm-hmm.
And looking back over the past month, the stock has experienced a broader post-earnings fade, down about 8–10%.
Especially when you compare it to the relatively flat XLI Industrials ETF, that's the exchange-traded fund tracking the broader industrial sector.
So investors clearly had a lot to digest. It wasn't just a simple thumbs up or thumbs down.
Absolutely. It was a clear signal that the market appreciates the growth, yeah, but it's very much scrutinizing the source of that growth and, the associated costs.
Okay, let's unpack this, because management made it very clear. This is an acquisition-led growth story.
No question.
That record revenue we just talked about.
Right.
The recent acquisitions were explicitly stated as the primary engine behind it.
And the sheer scale of that inorganic contribution is truly remarkable, isn't it? What's fascinating here is how these acquisitions, specifically Aspen Manufacturing, PST Products, and PF Waterworks, they added a significant $43.7 million in inorganic revenue this quarter.
Almost $44 million just from deals.
Right. That essentially offset the organic declines we just mentioned. It paints a picture of a company strategically buying its growth.
And Aspen seems key here. Acquired May 1st for, around $313 million?
Yeah, Aspen Manufacturing is a cornerstone of this strategy. It specifically broadens their HVACR portfolio, heating, ventilation, air conditioning, and refrigeration.
Expanding
into things like coils and air handlers, big components.
So they're expanding their reach in a crucial market. But you mentioned margin compression earlier. Does Aspen play into that?
It absolutely does.
Right.
This expansion with Aspen comes with a targeted 24% EBITDA margin for Aspen in fiscal year 2026.
Okay.
Now that's a bit lower than the legacy contractor solutions segment's typical margins.
So it drags down the average.
Precisely. It directly contributes to that near-term margin compression we're observing. Management frames this as a very deliberate strategic pivot, though.
They're okay with that.
They are consciously accepting some transitional margin dilution today because they believe it will allow them to expand market share and gain pricing power in the long run.
A classic long game play, trading margin percent for market share.
Exactly. They also noted that the integration of PSP products and PF Waterworks is going really, really well. They use the word phenomenal for growth rates there.
Good to hear.
While Aspen's integration, being newer, will accelerate after its busy season. Takes time.
So CSW Industrials is essentially saying we're investing in growth, and that means some short-term pain for long-term gain.
That seems to be the message.
But even with all this acquisition success, the organic revenue softness, particularly the 4.6% decline in their contractor solutions segment, that was a key point of discussion.
It was.
What's driving that softness, and how concerned should we be?
Well, if we connect this to the bigger picture, several factors converge to create this softness, and it's important to sort of differentiate them. Management cited a challenging market environment with soft housing activity, which directly impacts their construction-related products. That's one piece.
Makes sense. Housing's been tricky.
They also pointed to a non-recurring distribution center stock-up event in the prior year.
A tough comparison.
Exactly, and some product volume being pulled into the prior fiscal fourth quarter as customers prepared for certain changes. So, some timing issues there.
Okay.
But crucially, they observed a definite shift from HVAC unit replacement to repair by consumers.
The repair versus replace dynamic. We hear that a lot lately.
Think about it. Higher cost of new units, new refrigerant standards coming in. People are fixing what they have rather than buying brand new.
Especially those big ticket items.
For example, GRD sales, that's grills, registers, and diffusers, heavily tied to new residential construction, they were significantly down.
That makes sense. We're all feeling the pinch right now, and repairing an appliance is often cheaper than a full replacement.
Definitely.
But management is calling this a one-quarter blip. Is that really plausible given these broader economic and consumer trends? Feels a bit optimistic.
It's a bold claim, yeah, and it's something you, as a listener, should definitely scrutinize. Their optimism seems to stem from anticipating mid to high single-digit organic growth in contractor solutions for the remaining 3 quarters of fiscal 2026.
Mid to high single digits. After a decline.
That's the forecast. They believe this will be driven by recent pricing actions they've taken and an expected pickup in demand.
So they think the price increases will stick and demand will come back.
Essentially, yes. They're betting on the idea that the repair not replace trend is more of a temporary economic response rather than a permanent structural shift.
It's a key area to watch them because it will validate whether their organic engine can indeed rebound.
Absolutely critical.
Speaking of pricing actions, the gross margin contraction of 370 basis points and the EBITDA margin decline of 280 basis points, those really highlight the significant cost pressures they're facing.
They do.
How are they navigating tariffs and broader input cost inflation that, so many companies are grappling with?
Yeah, this raises an important question for any industrial company today. CSW Industrials has actually been quite proactive here. They've been shifting third-party manufacturing out of China for years. It's not a new thing for them.
Okay, ahead of the curve somewhat.
Yeah, seems so. They now expect contractor solutions cost of goods sold exposure to China to be around 10% in fiscal 2026.
Only 10%? Where did it go?
They've made a significant shift to their own facility in Vietnam and other Asian countries, with the remainder primarily produced in the U.S.
And Aspen, the big acquisition.
Aspen Manufacturing's production, importantly, is entirely U.S.-based with minimal foreign sourcing, so that inherently helps mitigate tariff impacts for that acquired business.
That's a big strategic plus right now.
Definitely.
Yeah.
And the company implemented pricing actions back in June, primarily in the low to mid-single digits.
Just recently, then.
Yeah, specifically to cover current tariff exposure. So the strategy is clear. Protect margin dollars, the absolute profit they make.
Got it, the actual cash.
Right, even if it means some near-term margin compression as a percentage.
That's a strong stance. Prioritize the absolute dollar value of profit, even if the percentage looks lower in the short term.
It shows a certain confidence in their long-term strategy, doesn't it?
It does. It suggests they're focused on total profitability and cash flow, rather than just, percentage points on a spreadsheet.
For you, the investor, it's about understanding that distinction and what it means for their financial health.
A notable development this quarter was the introduction of a new adjusted EPS metric. Why the change? What's behind that? And why is it important for us to know about?
The rationale for this change is actually quite straightforward, but it's crucial for understanding their true operational picture. With a decade-long cadence of mergers and acquisitions, M&A, well, the amortization of acquired intangibles has a significant impact on their GAAP EPS.
The standard accounting measure.
Right, GAAP, generally accepted accounting principles, earnings per share. This adjusted metric, it excludes that amortization, essentially, the accounting cost of spreading out the value of things like brand names, customer lists, patents acquired in a buyout.
Stuff you buy in a deal.
Exactly. It aims to provide investors with a clearer measure of core operating growth and profitability, free from that specific accounting noise.
Makes sense, especially with all their M&A.
Yeah, for fiscal year 2026, the forecasted consolidated amortization is $39 million, including a substantial $11.6 million just from Aspen alone. It's a big number.
So it's about giving a more transparent view of their core business without the accounting effects of their M&A strategy muddying the waters.
That's the idea. Better comparability over time.
What about their capital allocation? Do they still have dry powder for more acquisitions after Aspen?
They absolutely do. The company maintains a remarkably strong balance sheet. Their net leverage is just 0.2x.
0.2? That's incredibly low.
It really is. To clarify, net leverage is basically your debt minus your cash, divided by your operating earnings. A Buildy 0.2x ratio tells us they're incredibly financially flexible.
Plenty of
Loads. And this is even after paying down $40 million of debt related to the Aspen acquisition.
Wow.
Now, while they're actively pursuing accretive M&A, meaning acquisitions that immediately add to their earnings per share, they did acknowledge an increased hurdle rate.
Because money's more expensive now.
Exactly. Due to the current cost of capital and, risk premiums. So while they have the capacity, they're being more selective.
Which is prudent in this environment. You don't want to overpay.
Definitely a smart approach right now.
Beyond the consolidated numbers, let's look at how the individual segments performed, because there's always a story behind the overall picture. Helps understand the moving parts.
Absolutely. Let's break it down. First, the Contractor Solutions segment. As we said, it saw organic decline, but still delivered 22.6% total revenue growth thanks to those acquisitions.
Driven by Aspen, PSP, PF Waterworks.
Right. And as we discussed, management expects it to rebound organically in the coming quarters. That's the expectation.
Okay, segment one. What's next?
Next, the Specialized Reliability Solutions, or SRS segment. It saw a flat revenue, but its EBITDA margin contracted significantly.
Why the margin hit there?
A few factors. A sales mix favoring lower margin products, commodity price increases hitting them, and some one-time expenses.
One-time expenses from what?
From consolidating a sealants manufacturing facility into their primary facility in Texas.
Plant consolidation. Short-term pain.
Exactly.
Yeah.
This consolidation, while creating that short-term margin pressure, is actually a strategic move. It's expected to drive higher margins in the long term. They have a 20% EBITDA margin target as an intermediate to long-term goal for the segment.
Okay, so an investment in future efficiency.
That's the plan. And finally, the Engineered Building Solutions, or EBS segment. It had modest revenue growth, but also experienced margin contraction.
Same story there. Costs.
Pretty much. Primarily due to tariff-related material cost increases, some warranty claims they had to handle, and significant growth investments.
Investments in what?
In sales and R&D, research and development. These investments are aimed at pursuing new projects and driving future revenue, including some really interesting opportunities related to data centers for their fire-stopping products.
Data centers are huge right now. That could be a good growth area.
Potentially, yes. The good news here is that their backlog quality is improving, which is favorable for future margin mix.
Better quality projects in the pipeline.
Right. And this segment also targets a 20% EBITDA margin long term.
So across the board, we're seeing some short-term margin pressure, often tied to strategic investments or consolidations that are expected to pay off down the road.
That's a fair summary. Intentional trade-offs.
And for the full fiscal year 2026, the company anticipates growth in revenue and adjusted EBITDA for each segment.
Not just consolidated, but each one.
Right. Plus consolidated EPS growth and stronger operating cash flow compared to fiscal 2025.
That's a very confident outlook, especially after a quarter with some organic softness in those margin hits.
It really speaks to their conviction in the strategic decisions they're making today, believing the benefits will materialize strongly throughout the year and beyond.
They're putting their chips down on this strategy.
So, after this deep dive, what does this all mean for you, the investor, looking at CSW Industrials? The sentiment coming out of the call. I describe it as cautiously bullish. It's not a runaway train, But there are clear positives.
Indeed. On one hand, you have that undeniable growth from M&A, resilient cash generation, and a very strong balance sheet offering flexibility. Hard to argue with that.
The positives are strong.
But on the other hand, the market is clearly scrutinizing that margin compression and the softer organic volumes. We saw that in the stock's post-earnings fade compared to the XLI.
Right, the market's weighing those near-term costs.
Exactly, a key catalyst to watch. Well, natural seasonality of HVAC demand that always plays a role. Also, pay attention to the acquisition anniversary roll-offs. PSP becomes organic in August, PF Waterworks in November.
So that growth will soon count as organic, potentially shifting perception.
Could do. It changes the metrics. Any future tariff-related relief would also obviously be a boost.
And what about their internal moves, the stuff they control?
Their continued channel penetration, leveraging that national footprint for newly acquired products like TrueAir and Aspen. And that's important. And their targeted investments in R&D for segments like EPS, especially those potential opportunities in data centers we mentioned, are also key drivers to watch.
They also moved exchanges, right?
Good point. It's also worth noting the company's strategic transfer to the New York Stock Exchange back in June. Management believes that will benefit shareholders long-term through increased visibility.
All right.
So the bottom line is the company appears to be making intentional trade-offs today for a more dominant position tomorrow. But the market is still weighing the immediate costs of that strategy. The big question really is, how long until the market truly appreciates this long game pivot?
A crucial question indeed. Now, for something a little different, this segment is purely for thought-provoking discussion, not investment recommendations.
Please remember that. Just an idea.
So please take it as an intriguing thought experiment. But our expert always has an outrageous but plausible trade idea based on today's deep dive. What's caught your eye this time?
All right, so here's my pitch to the Imaginary Investment Committee. I'd recommend a long position in CSW Industrials, financed by a short position in a pure-play residential HVAC OEM.
Okay, define OEM for us quickly.
Original equipment manufacturer, a company that primarily makes new residential HVAC units, the big boxes themselves.
Got it. So long CSWI, short a pure-play HVAC maker, one that lacks CSW's diversified end market exposure and domestic manufacturing capabilities.
That's the pairing.
That's a bold play. So you're essentially betting on CSW's strategic flexibility and hedging against the more rigid players in the market.
Pretty much.
Can you quickly break down the core argument for why CSW is better positioned right now and how that short leg works?
Okay, the thesis is this. The market is currently over-penalizing CSW for its near-term margin compression and organic softness, interpreting it as fundamental weakness.
But you think that's wrong?
I think it might be missing the strategic angle. Management's one-quarter blip assessment for organic growth in contractor solutions. Well, if they're right. Couple that with the strategic benefits of Aspen Manufacturing's largely U.S.-based production and its exposure to that repair from replacement trend we discussed. There seems to be a significant disconnect.
So CSW is playing the repair game better.
It's positioned for it, yes. While the broader residential HVAC replacement market is genuinely challenged by high unit costs and new refrigerant standards, CSW's diversified portfolio is actively pivoting. It's trying to capture demand in this changing environment rather than being solely exposed to that high-ticket replacement cycle.
So you're saying CSW is agile enough to adapt, while others might be more stuck in the old replacement model.
That's the core idea. Plus, furthermore, the company's low net leverage, that 0.2x, it means ample dry powder for further accretive M&A.
They can keep buying.
Transforming it into an even more scaled and diversified industrial platform. The short leg provides a hedge against continued macro headwinds.
Hedging again.
Specifically targeting companies more exposed to that high-ticket replacement cycle and the direct impact of tariffs on foreign-source components areas where CSW is actively de-risking its own operations.
So it's a relative value play based on strategy and execution.
Exactly. This is a play on strategic adaptation, strong balance sheet optionality, and a bet on that near-term organic recovery. Betting that CSW's proactive measures will eventually be recognized by the market, potentially leading to a significant re-rating as the inorganic growth converts to organic metrics in the coming quarters.
Fascinating idea. Again, not advice, just a thought experiment based on the call.
Just an idea.
So there you have it. CSW Industrials, a company strategically reshaping itself through acquisitions and a deliberate pivot.
Facing some short-term organic headwinds, yes.
But expressing strong confidence in its full-year guidance and its long-term vision.
What's truly fascinating, I think, is watching how companies navigate growth while actively reshaping their core identity. It's not easy. CSW is intentionally trading some near-term margin for future market power. The central question for you, the astute listener, is how long will the market take to fully appreciate that pivot? And what opportunities or risks does that present in the interim?
A crucial question indeed. Remember, the insights shared here are for informational purposes only and definitely not financial advice.
Please do your own research.
We encourage you to do your own research and analysis. Thank you for tuning in to The Deep Dive.
We'll be back soon with another deep dive into the earnings call that matters to you.